So my question was, I usually struggle with the whole idea of, revenge trading. You take one trade, you take a loss, and then you can't take the loss, and then you go and do it again, and then you take another loss. So the whole psychology idea is what I wanted to cope with.
Well, there's a lot of content about that, right? So, but it'll be interesting to get Michael's fresh take on that right now.
If I understand you correctly, you're asking how you can overcome the tendency to want to revenge trade and get back a loss or square yourself immediately once you have done damage to your equity. Is that what you're asking, or is it something more specific to that?
Yes, sir. Yes, sir. That's exactly what I'm asking.
Well, number one, do you journal?
Yes, I do journal. Yes, every day.
Okay, can you give me a kind of like a broad brush overview of what it is that you actually specifically journal and what are you targeting in your journal entries?
All right. So in my journal, so first thing I start with whether my bias will be bullish or bearish for the day, and I mark out the PDRAs that I'm gonna use to take a trade on, and then what I would be interested to see price do. And lately, maybe if I get a TP, I will, you know, write down the risk rewards and stuff. So something to that effect.
Do you have a well organized and written trading plan? Like, what's your model? Is it something that
Uh,
constantly changes? Is it something that you're always tinkering with?
Actually, yeah, I kind of got confused because I started with the 2024 model, and then I watched all the 2026 videos. I trade Usually I trade the first presentation, opening range gap, and liquidity sweep, and I use the first presentation as a way of, taking a trade. That's usually what I do.
Okay, it sounded, and I may be misreading you, and I'm trying to be very careful. I don't want to make you feel like I'm coming at you. So we're just having a conversation, okay? But I want the folks that are also listening to this to think about themselves and how they may be in the same situation or have encountered it in the past, or you will probably do it in the future. I think that if I were to be blunt and go right to the heart of the matter, out of teaching lots of students and having lots of engagements with students all around the world and varying different models that they've used with my concepts, that the common denominator is they do not have a fixed model that they're leaning on as a go-to. It's a bread and butter type. Every day, I'm only looking for this for right now. And because I'm someone that kind of like wants to serve everyone, I have an entire buffet table of things you can choose from to kind of like fit your personal personality and trading style. But that's a lot to take on when you're brand new and you're not really experienced. So I simply say this because I think what you're trying to do is, as you watch price action and you see something there, it may be outside of your model. It may be outside of the specs that you have first sat down with and said, okay, today I'm going to try to go long, or I'm going to go short, and I'm going to target this thing here. But then price action does its little charming little routine, and it hypnotizes us and makes us fall in love with whatever price action wiggle and waggle it creates at the moment while you're watching it. And you think, well, maybe I was interpreting that wrong. And maybe I'm going to try that thing Michael was talking about where it looks like it's an inversion fair value gap. And maybe you've never traded inversion fair value gaps, but you just want to try it today. And then you hurt yourself. And right away you feel regret. And I'm not saying you do this, but just bear with me. Let me kind of like put down some tent posts here. The idea of taking on something that you don't really have as a model, that you haven't really done back testing on, that you haven't had any data, no no real history with it. Okay, think about it this way: if you owned a business and you hired 20 employees, and each one of these employees had their own individual responsibility, they have a task. Okay, maybe two or three of them are in a specific department, but they don't all do the same thing. They have certain primary functions that they fulfill. Would it be reasonable for everyone to come in and just decide to change their role in your business and just do somebody else's job because they just felt like it would be better for them to do it? Would you permit that to happen in your company?
No, definitely not.
Right. And what happens is when we start these trading businesses, if we don't have a well-written business plan, which is our trading model, and have history working with the numbers, doing you know research and development, making sure that we have something that's going to be profitable, we would never invest more money or hire employees to do jobs that won't yield them a paycheck. So when you're looking at price action, and when we as traders are inexperienced, many times we try to take on the task or job of another trader's setup when you're not skilled or trained or prepared to do their job. So it's best for you to try to stay inside of a very small circle in the beginning and use that small circle of influence where you only engage with what this model calls for. And if you can operate in that very small circle of influence to what price is doing, you end up developing patience. You master yourself, which is the most important thing. And you can't master yourself unless you have a model or a criteria that you adhere to. And it feels very confining and restricting in the beginning. And it feels like you're missing opportunities. And you're not. You're actually developing a skill set that helps you refine your attention down to a very specific criteria. And if that criteria is not well written, if it's not written out in a plan that's easily understood, there isn't a lot of moving parts, you're going to go off course and try to do another trader's job. And if you're trying to trade another trader's model and you've never done anything with it before, you shouldn't be surprised when adverse results come to your hands. So what you have to first do is adhere to a single model. Now let's jump ahead and let's assume that that's what you're doing. Okay, I'm taking a great deal of liberty in assuming that maybe you are, but in case you aren't, okay, but I gave you that part already. Now let's jump ahead and say that you do have a model. You know what you're looking for in terms of a setup. In other words, what constitutes the trade going higher or lower? What draw on liquidity are you going to use as a reference? Is it going to be session highs and lows? Is it going to be a new week opening gap, high or low? Is it going to be a new day opening gap? Is it going to be the opening range? You're going to trade the first fair value gap that forms there, and you're going to look for relative equal highs or relative equal lows. And then once you get that, you're done. You're not going to try to do anything more in the day. You're not trying to trade the PM session. You're not trying to do the whole entire daily range. You're just going in there, you're getting your bite-sized cookie cutter approach to get your pound of flesh for the day and then walk out. Assuming that's the case, when you do this, if you suffer a loss, your rules, your well-written model should tell you that, okay, I took a loss. Was it a full maximum loss for the day? Now, when I say that, that's not the same thing as these prop firms where you can lose $6,500 or whatever it is. You know, that's pretend. That's monopoly money. When we're talking about a full loss, if you take a full 1% loss, you need to stop. So if you're taking trades where you're affording yourself the luxury, it seems like, but it's the horror show. Once you get that full 1% at risk and it takes it from you, you think to yourself, well, I can probably go in and get that back because I did something silly. You know, I knew I should have waited for this because hindsight's 2020. You see a little bit more price action, a little bit more candles are giving you a better depiction of what you didn't see at the time. And you maybe you do have a model, but you got overzealous because maybe I posted something, maybe I shared my opinion about something, someone else said something, or you just watched price action just spin off and start running, and you think you're going to miss the move. Missing the move or feeling inspired to get the trade back as a loss and back in the win column and get back to even, those two things many times are spurred on because of a lack of focus, not adhering to the model, not adhering to the rules. And if you take a full loss, whatever your full maximum risk is per day, if it's a 2% drawdown, if you hit that, you have to stop. You got to go do something else. I think 1% is fair. I think it's reasonable. And if you're brand new, a 0.5%. And I know in the beginning that doesn't feel like that anybody should be aspiring to do that. But you can see right away, we're having lots of parameters, lots of boundaries, lots of lines you can't cross. You got to stay inside this small little circle. Who's going to hold you as a trader accountable? Just you. Just you. And the only response to you doing the wrong things is the market correcting you. Now, if you're doing things out of spec, if you're doing things that are just generally wrong and you're offside and you don't have the right idea where the market's going to go, you have to let the market tell you. And how's it going to communicate that? It only communicates that with losses. So if you're going to have that dialogue with the marketplace and you're going to allow it to communicate to you, why would you give it a bazooka or a tank and stand in front of it and say, listen, when I make a mistake, blow me to smithereens, just completely wipe the floor with me, turn me into a pink mist, or give me a paper cut so that way I can realize I didn't do something I should have done, or I didn't see something, so it wasn't that harmful to me. I live to fight another day. Or if you're risking a 0.5% and your maximum drawdown for one day is 1%, guess what that affords you? You can take another shot because you haven't taken a full stop in terms of your risk that's allocated for one day. But when we go into trading and we're first now introduced to the idea of potentially making money, we like to flirt with the idea that, well, I'll see what happens. I'll do 2% risk because it's my first time out. And if it wins, I could probably do very well. And that's going to encourage me. And you want to stay away from those types of things, because that's like going to the bar with your friends while you're married and you put your ring in your pocket and say, well, I just want to see if I can get any girls to find me attractive. I won't really do anything with them. But then when that really pretty one comes up, now you're put in a situation where, are you going to be strong enough to say no? Are you going to be able to live that life as that husband and stay inside those boundaries? So don't give yourself that enticement. Don't allow yourself to do that. And it's very hard to do these things as a trader because you're the only one in control. But the only punisher is the market. So you have to allow it to communicate to you that you're wrong, but don't give it so much power and control over you that when it does correct you, it's trying to destroy you, because it's indifferent to how much leverage you have. It doesn't know how much risk you have on. You are in control of that. But many times when we're in a drawdown, we like to personify that the market somehow chose you today to teach humility because you haven't learned it yet. So now it just singled you out today and said, now I'm going to teach this guy or this gal, you need to learn this today, and I'm going to destroy you. I'm going to run you out, and you're going to have to reset or refund your account. And all these things are constantly going through our mind because the discomfort of no control. We don't have control of where these markets are going to go up or down. We don't know if it's going to go to our target. And by submitting to these things in the beginning, if you don't have a well-rounded written model, you're left to your own emotions and psychology and concern about every single fluctuation in price action. And the only way that you can compensate for that is by having a long history of backtesting, looking at how that model you're implementing worked in the past, and then forward test it with tape reading, then demoing it. And the more work you do in that, it takes all the uncertainty and the fear and replaces it with, am I sticking to the model? Am I sticking to the rules? Is the candlestick supporting everything I set up for a reason to be in the trade? If you're focusing on those things, you cannot, it's impossible for you to be worrying about the outcome of the trade because your attention is focused on what is every individual candlestick telling me. It's giving you feedback. And if you think about it that way, if you're long, a down closed candle or a bearish candle that's forming, you're going to see those form. But your attention is it coming down to a discount array? Is it respecting that? Are the bodies staying in the upper half when bullish? Is it doing these things I like to see in price action that considers us on side or order flow being still bullish? If you're doing these things, you won't be led by your emotions. You're not going to be tugged by the heartstrings and say, I wish I would have done more. I wish I wouldn't have put this trade on. You won't have all these things. And you allow the market to show you you're wrong. Let the stop loss do its job. And then after the transaction completes, do you still have enough to take another trade for the day? If you don't, or if you are extremely keyed up emotionally, force yourself, remind yourself that it does not have to come back into your account today. It's a loan. That's all it is. You're giving the market a loan that you're going to collect with interest. You're just not demanding that interest be paid today.
Wow. Buar?
Thank you so much, sir. I completely understood. That was great. I'm gonna stick to that actually.
Very good. I'm glad I was helpful to you.
Thank you. That was very helpful actually. Because if I'm gonna be honest, I've been struggling a lot because I did the same thing with my model. I tape read for about 4 to 6 weeks, and then I went on a demo trading, paper trading for about 6 more weeks. So around 12 weeks or more, I started I just got a funded account, and it's kind of new, and I'm not kind of familiar with the whole idea of having your own capital, let's say, to trade with, and it's kind of fearful at the first time doing it.
That's understandable, but there's no way around it. Like if you're choosing this career path in entrepreneurship as a trader, you have to embrace that uncertainty, but you have to disarm the marketplace. You have to disarm it. And the only way you can do that is by sound money management and risk management, not over leveraging, not making yourself available for more damage. And also, when it corrects you, if you look at it this way, the market is the parent, and you're forced to be subordinate to it. You can't master it. It'll never be mastered by you. I never master market. Nobody else has mastered the market. It's the position of authority over top of us, like a parent, and we're subordinate to it. And if we are subordinate to it and it corrects us, what type of response is this authority going to have on us when we stand in front of it and say, I'm not going to listen. I'm going to do more of what I just did, and I'm not going to take that as corrective instruction or deterrent. And I'm going to do more of the same and be extreme about it. What type of response would you reasonably expect to see? More losses, right?
Absolutely.
Yeah, definitely. Yeah.
So when we are being corrected, we have to be subordinate and say, okay, I'm seeing something, my present understanding or my read on the marketplace, and this is something that men simply can't get it in their head. There's nothing wrong with saying, I read that wrong. I read that wrong. And I saw something there that I acted on. It looked like it was in my model. I executed on it. Things changed. Maybe you saw it you breaking down while you were still in the trade, and you could have collapsed it, but you didn't. But it's okay. These things are going to be a progress. It's something you're going to pick up over time. And you can't know it right from the beginning. Nobody knows it from the beginning. But you have to disarm the market so that way it can't hurt you to such a degree where it removes your participation or it messes with your psyche. If you start worrying about everything that you do in terms of taking a trade or missing moves, like I don't miss a move, I think, oh no, oh, goodness, I wish I would have taken that. I'm never going to be able to find another trade like that again. I mean, good grief. That doesn't happen. And everybody out there that has a model that works well, that holds up over time, they don't miss moves either. They don't go to bed and cry themselves to sleep because they missed the Bitcoin rally, or they missed this, that, and the other thing, or they missed the silver rally, or they missed the silver collapse. They don't think that way. New traders or people that don't have a model or action hounds, gamblers, basically, they always talk in terms of regret. And you have to guard yourself and make sure you don't record things like that in your journal. And you got to make sure that you don't think that way or speak that way while you're in front of the charts. And it's real easy to do. You don't realize you're doing it until you catch yourself. And if you're not listening for it or paying attention to it, you'll actually talk yourself into this victimhood. And victimhood tends to spawn this gambler type mentality. And we don't like feeling like we did something wrong. We don't like it. Just like a child doesn't like to be scolded by their parent. They don't want to cry because they're frustrated. They want to be able to say, no, I don't want to do what you told me to do. And when we do that in tantrums in the marketplace, in our trading, it's very expensive. And then we blame many times externally things that had nothing to do with why we did it. And we constantly feed ourselves this loser's loop cycle that constantly goes over and over and over again. You keep doing the wrong things and thinking the wrong way about it all. When it all goes back to us as the trader, we have to be in control of ourselves. We're not in control of the market. We have to submit to that uncertainty. We have to embrace that. But we have to give the market the opportunity to communicate to us that we're right or wrong. But when we're wrong, don't give it the tools and the weapons to remove us entirely or do so much damage that we can't follow that model anymore because the model's proven itself. It's there. But you, as the operator, you may have done something incorrectly with it. And that's a reasonable thing that's going to happen. It's going to happen. Sometimes I do the same thing. I got models that are just really, really good. But sometimes the old man thinks he's better than the average bear, and I'll go out there and I'll engage with it. And I'm like, oh, yeah, I'm wrong. I didn't do that one right. And I either have to close it or I'll just let it have the stop. It's okay. But I'm not throwing that model out and saying, man, I'll never touch that one again because it didn't work in my favor. And I'm not thinking, well, I better get it back real quick because I know that the market's going to be there tomorrow. I know the opportunities are going to be there tomorrow. I know that the market's delivered on a time-based delivery schedule. So that means since you know what time it is, you know what day of the week it is, you can schedule your next opportunity. It's not a matter of us waiting around to react. And that's what you have to remind yourself. And that's what you do in your journaling. You remind yourself when you have a losing trade, or if you're in drawdown, you tell yourself, I'm so thankful that I don't have to worry about these things running out of opportunity. My model will repeat again. And I have done something that's out of spec today as the operator with this model. And that's normal because I'm learning to get better at doing it. And now I have experience that it costs me a little bit. Just like a college degree, just like you going to work, you got to go to a trade school and you get some kind of a skill or with a certificate or whatever. You had to invest in that to get that new skill set. Well, now you have a new skill set that the market cannot take away from you. You have experience dealing with that criteria, that type of thing, with that mindset you applied at the time when you took the trade. And the worst thing that we can do as traders is to then beat ourselves up and say, well, you did this wrong. You're never going to do it right. You're going to constantly blow the account. You're going to take more losses all the time because you can't control yourself. That's the worst thing to do. You have to tell yourself that it's normal for you to take a loss. It's normal for you to feel uncomfortable at the loss, but then you come in and you counsel yourself because no one else is going to do it for you. You have to remind yourself that this is all part of being a trader. You're going to have lots of losing trades throughout your career. And the faster you warm up to the idea that they're harmless when you control the amount of leverage that's been utilized for that loss.
Thank you so much, sir. I understood. It's highly appreciated. Thank you.
Awesome.
I love it. I love it. We got folks coming up. We have XTR extra K extra K.
Yeah, yeah, y'all can just say extra. What's going on?
Okay, yeah. Go ahead. How do you say your name again, bro?
Yeah, you just say extra.
Okay. You got a question for us today, bro?
Yeah, yeah, yeah. I was wondering if there were any criteria. Excuse me, Robert. I was wondering if there was any criteria to disqualify what you may perceive to be forming a mohawk.
Is there a procedure to do what again? I'm sorry.
Like if you're watching a level and you're expecting price to respect it, and maybe it's gone past it already a little bit, and you're expecting maybe now it's going to give you a mohawk, then it ends up not being a mohawk and it ends up just running through the level. Is there any criteria on a higher time frame, like the daily and weekly, to disqualify that, or is there any like steps I could implement to kind of like know, okay, this is where I should stop with this mohawk,
Okay.
or thinking that this is gonna?
Let me paint a scenario for you. You're expecting lower prices on a particular market, and the market gives you a rally that takes out a previous high intraday, but you're bearish, and then it starts to break down. And then you can look at that little gap that formed as a buy side imbalance, sell side inefficiency, as it made a higher high. Now you can extend that over to the right and assume that may perform as an inversion fair value gap. So if your question is how do you know, or what procedures would you have to feel confident that any coloring outside the lines above the high of the inversion fair value gap should not be just another run higher to higher high, but in fact, just a little bit of outside the coloring of that inversion fair value gap, then continue going lower. Is that correct? That's what you're asking for?
That's a good setup for like what I'm looking. Yeah.
Okay. First of all, number one, it's experience doing it. And experience is something you're always getting more of. I'm always getting more experience every year I to be able to do this. I'm gaining more experience. So number one, just understand that that is the first important thing to know, that without that experience and without a measurable amount of it, you're going to feel uncertain. You're going to have to just do it. If it closes outside of it, okay, if it closes outside of it, then obviously it's a dead ringer. It's going to keep running. What do you do with that? You take the loss. Or if you feel uncomfortable with it, if you have something in terms of size that allows you to take half the position off, take half the position off and let it have the balance of the stop. But there's a kind of like a confluence of several things. We're not just simply looking at a 1 minute chart and saying, well, I think it's going to go lower, and I'm going to grab that line right there and assume that it's the high of the inversion fair value gap or the high of a bearish fair value gap. And I'm okay with it coloring outside the lines, but I don't want to see it trading too far above it. Now, I teach a principle of 3 PD arrays should be your defense around whatever you're doing to take a trade. So in your entry or in your stop loss management, you should be able to look at that price action and say, okay, there's that inversion fair value gap in the example I painted here. It's a bearish move you're expecting. The high, we'll just say, just for sake of completeness and for easy for me to describe, say you're trading gold and it's at 4,000 even at the high of the inversion fair value gap. And then you have the highest high it just recently just made in intraday price action is 4,050. But then below that, you have a rejection block. Then you have the highest up close candles opening price, which is going to be the bearish order block. And then you may have the high of that inversion fair value gap that you're entering on. So you may be able to say, I'm going to just risk half of the order block, which isn't going to be the rejection block. It's going to be the mean threshold or half of that up close candle's body. That affords you a measure of what you don't want to see it breach. So in this case, if I see something like that, normally I'll go with the rejection block as a stop. That's where I open up usually with a hard stop there, unless I feel extremely confident that I can just go above the inversion fair value high and maybe 5 handles above that, and then I'll just stick with that. In this case, you can use the order block theory, and half that order block should be your defensive mechanism. So if it goes beyond that, then you're stopped out. So while watching it coloring outside the line, the high that inversion fair value that you're trading on, you tell yourself, I'm okay with it trading to the order block's opening price. I'm okay with that happening. I'm okay with it trading above it. But I have to be mindful that if it goes to the mean threshold, I can't let it stay open. I have to kill the trade. And you may have a stop loss that's higher than that. So you protect the stop and you submit yourself the idea that you probably read it wrong. Or if you have 2 contracts on or something to that effect that allows you to take half the trade off of, while you're grooming yourself to prepare for sitting in trades that aren't immediately delivering and you have a little bit of flirting outside the lines, this is good for you to go through. It's conditioning. It's something that every trader doesn't want to do. We all want to get in and it starts running in our favor and this keeps on going. It isn't always like that. So number one, it's experience. And if you don't have the experience, what I just described helped you get that experience.
Thanks, man. I appreciate that breakdown, and I kind of figured it would probably have to do with some of the other technicals that you tell us to help build confidence around the plays. But for some reason, I kind of thought it would have to do with like measuring the candle or something. I don't know,
Well, we
but
did. It
I
is.
appreciate that.
It is. That's what we just talked about, measuring the midpoint of a up close candle prior to it dropping. That's the order block. So if it's going to be the mean threshold halfway point, we don't want to see it breach that, and then we don't even have to
Oh,
pull.
you
Okay.
also you were just then you were describing the candlestick that looked like it was giving the mohawk. That was the candlestick that you were measuring,
No,
or the candlestick that it was reaching up into it you were measuring.
it would be the last up close candle that made a higher high intraday. So like it would be taking short term buy side liquidity out.
Oh,
Then
okay, got it,
it creates the inversion
got
fair value gap. And then the candle that's retracing up into that fair value gap that you think is going to act as an inversion and send it lower, it
got
may
it.
start building a wick outside of it. Just compare that with what the mean threshold is, or half of the up close candle that made the highest drop down from. Because you don't want to see it go up, make a higher high. But we don't want to use a rejection block as a stop either. So we can put mean threshold as the boundary and just see what we can get out of it. And if it can be managed, then wonderful. If it doesn't, we're going to take the hit.
No, that makes sense. I appreciate it. Can I ask one more question?
Sure.
All right, as it stands right now, the only order blocks that I use are two candlestick order blocks. But I know that you've talked about order blocks where it's significantly more than two candlesticks. But because it's like one side of it is just pure buys and one side is pure sells, you consider, and then the fair value gap that comes as a form of expansion after. I was trying to figure out,
Because
does it
could you explain what you mean by
okay.
two candlestick order block? I don't know what you mean by
Like so say for example 5 minute time frame. Say at 9 the 9 o'clock 5 minute candle will be bearish, and then the 9:05 5 minute candle will be bullish, and then it will keep expanding, creating that fair value gap, and then keep going, right?
that. How's that order block?
Well, it would be the last down candle in the downtrend, and then the fair value gap that comes as a part of the expansion, or the leg, the part of the order block that expands from.
Moves higher?
Yeah.
Okay.
So I was trying to see. So I am talking about the right thing, right? First of all, before you.
The term, does it help if we use the term engulfment?
Yeah, engulf. Oh yeah, that's fine. Yeah, the
Okay,
engulfing
I'm
part.
just trying to add clarity because that might be difficult for some folks. You're looking for the candle that is reaching over the previous the low. You're
Right.
doing a two candle sequence, and Michael is asking you to explain why or where did you get a two candle sequence, because just hear me out. A fair value gap needs a minimum of three candle formation to create a
Did
fair
I say
value gap.
fair value gap? I did not. If I said fair value gap, I didn't mean to say fair
Well,
value gap.
you were
I
talking
was I
about
was
an order
talking about.
block, and I understand, and you're referencing two. Where are you referring to two? And you're going from the order block, but you're referencing an engulfment. That's, I
Mhm.
think, where we have clarity, Michael. And beyond that, I'm not sure.
So the order block would be, all right. So if it's a bullish order block, the candle, the order block would be the down candle, correct? Am I
Assuming
misunderstanding
that
that?
assuming the market's primed to go higher,
Right, right.
it drops down. Okay. And then there's displacement higher. And that displacement higher sets up either the validation of a return back to the candlestick that was a lower moving down close candle. That opening price is changing the state of delivery. That's going to be sensitive once it clears that. So it can come down and touch that. If the market's still bullish, it should get a reaction there. But it can trade
Right.
down to mean threshold in that little range because we're using the upper half of the repeater. That's the discount sensitivity when the market's bullish. But it doesn't have to. It can create a fair value gap with that displacement candle higher and then trade down into that inefficiency or just keep on running. We don't know until the candlestick forms, and while it's forming, we have to make those decisions.
Right. So my question would be, if I see one of the order block formations that's more than two candlesticks, I wouldn't have to have it then turn into uh two candlesticks on a higher time frame. Say the order block was like an accumulation of 14 candlesticks. I wouldn't necessarily on a 5 minute time frame. I wouldn't necessarily have to go to the 15 minute time frame to make sure it was two candlesticks only to then confirm it, because that's what I've been doing. I've been saying if this doesn't on a higher time frame convert into two candlesticks, I don't take it as an order block. That's how I, if that makes
Okay,
sense.
so let's assume you're looking at a 5 minute chart because that's the time frame you keep talking about. So five
Hmm.
minute candlesticks, and you have two down closed candles.
Okay. Yep.
Then there's one candle that shoots up higher.
Yep. 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 I wouldn't consider that.
You wouldn't consider that what? What do you mean you wouldn't
I
consider it as?
I I, I wouldn't use that as an order block, and yeah, that's what I'm saying.
Okay, I would, because if the market's
Okay.
bullish and it's time for the market to show a displacement higher and reach for either an inefficiency it's above market price or relative equal highs or a single high. In other words, you think it's going to go higher, the draw is higher. If the second candle, okay, or the lowest candle in the two down closed candles formed, and that was the larger of the two, then the opening on that larger one, that's a change in the state of delivery. That's the order block. That's the one that's going to be validated. If they're basically the same size, then change in state of delivery is going to be the first down close candle's opening price. So you're going to have to wait for it to trade above that to validate. It doesn't have to close above it, but once it trades above that, now change in state of delivery is active. So you would expect it to be bullish.
Good copy. That makes sense. Thank you so much for the answers and for the time. I
You're very
appreciate it.
welcome.
Great question. I like that question. That was good.
It's just really hard to see something in my mind because um, I'm not as young as I used to be.
No, but you're doing a
and
great
And I
job of
would.
explaining it. I'm pretty sure everyone here listening is like the mental image, and then most people listening, Michael, have the same vocabulary. So just you're able to rattle off what you're thinking and what you're seeing, similar to what you do in a live stream. And even though you have the visual component in the live stream, I mean, folks are able to pick up your thoughts. I believe I am. I mean, I don't know if it's just me. I know it's not just me. I know it's not just me. People
yeah, I
understand.
just don't want to fall short and
You,
have some
I don't. The
confusion.
good news is it's also recorded, and now we have a much stronger way in which we're archiving things and having people have notes and stuff within Trader Roundup. So, and we're working on getting it distributed too. The deadline has been to be on these podcast platforms. So I'm pretty sure that we're almost there right now, Michael. So if we're not already, but we're organizing significantly, and you can see it from the website, and that's for the listener, but also for you, Michael. So it's cool. I don't think the mic gate works today. So I could say all of the wonderful things with the stop loss being hit. The mic gate doesn't work today, but that's
Yeah,
okay.
stopped out,
Okay,
stopped out.
yeah, that's okay. We have a good trade idea today. We got stopped out today on the mic gate, but that's okay. We're trying. Um, anyway, keeping the conversation going, keeping it flowing. Thank you, Extra K. We had a young man here who was in my DMs. Where did he go? He had such good questions and he disappeared. That's unfortunate. I'll search for him again. I'd like to bring up, well, we're in question answer mode. So I would like to see for the audience if we have a good question here. Pippi Banks, you never do me wrong, from the charter community. It's going to be saucy. My mechanic from New York. You there, buddy?
Yeah, that's gonna be good.
Yeah, it's gonna be good. Typically is.
Yeah.
If we just got to get him, he's Pippi. You there, buddy? Because sometimes he's multitasking, and I'll like get a text from him like, "No, bro, I'm busy, like whatever. So come back to me." So I don't have that just yet, but
Yo, give me a couple of minutes. I'm
yo,
here. Though.
you there, Pippi?
Yo,
Yeah.
Yeah, give me a couple of minutes though.
All right, no problem. We got you.
I'm here though.
All right,
All
all
right.
right. We got a question coming from Pippi Banks. I got the Daily Profiler, Captain Matt Mickey here, veteran, and he's an ICT trader. He utilizes some data. And Michael, I'm not sure, but I would love for Captain Matt Mickey to jump in here and give us a little bit about himself and tell the audience more or less how he utilizes your concepts in his hands. So
Hey, Michael, can you hear me?
I can, sir. Nice to meet you.
Nice to meet you. We met before. I want to start it off with hopefully the words that come out of my mouth just bring glory to the kingdom of God, because this is a large audience I'm talking in front of. But started my journey with you back in 2017, and I was the guy that talked to you on Telegram, sent you my Army article. I went from homeless to green to gold, all this stuff. I told you, hey, I asked you permission back in the day.
I remember.
Hey, I found your
I
truck.
remember you now. I remember. Yep.
And you said something that really stood out to me, and it was like, would you rather your treasure be stored with gold or sand? And that really resonated with me. And so I started with, the $9 per 1930, OTE position that you used to give. And and that was perfect for me because I was in the Army. And at that point, right, like I've got traumatic brain injury from 6 IED blasts, 1 airborne concussion, and getting hit by a vehicle, right? So overseas has been real fun. Um, but like, then I went to the 930, then I started studying everything from you, and my detailed learning just went out there. He's like, here's the thing about like traumatic brain injury. It's actually a superpower because like I had to use all my senses to learn your material. I had to write it down, watch it multiple times, chew gum, listen, write it down, visually see all this stuff, right? And I've been doing this for years, right? Um, and then like I went to the 930 and then I started back testing and doing the things that you instructed. And then like I did your whole pan model. I back tested your whole pan model, right? And so my background is I have a master's in statistics, right, from USC. And so of course I back tested and have tried to apply one of my strengths to your concepts, and I banged my head up against the wall. And then you came out and said something very, very significant to me, right? You said you got to know when to turn a system on and to turn a system off, right? And I was like, duh. And like that led me down the rabbit hole of like going very, very in detail. Like I want stats on everything. And like I pulled stats and stats and stats of like the opening of the hour being but depending on where it's in relationship to the previous hour, if the opening was the change in the state, if the midpoint was the market structure shift, all this stuff. So my brain could see it. And then I started digging down into the kill zones, like, and I thought of those as conditional if then probabilities, right? And I found that, right? Like, so Asia did this, London did this. What is the probability of New York doing this? And what is the probability of the daily candle, blah, 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 and all the distribution. So I applied your concepts where I excel at, and that's purely statistics. But the one thing I learned, two things. So I'll catch you up since last time we talked. I went actually investment banking when I retired out of the Army, right? So I sat on a top three desk, right? I actually helped with the T+1 life cycle of a trade in that design. I was a glorified PowerPoint person. So I had a master's in statistics and 20 years in the Army, and they get a tax cut. They brought me onto the team, and I sat there, an overpaid editor for the PowerPoint slides at Goldman Sachs, the Fed Reserve, all these people that would submit when they were building the T+1, right? And so I learned a lot, and I was still thinking about how to be a trader, how to be a trader. And then eventually I did that for 4 years before they laid off 5,000 people, to the point where I was actually a trader in the collateral and margin department for the institutions, right? And I had the luxury of asking Lynn Martin and the CEO of the NASDAQ, does anybody truly know how a price delivers from the institutional side? And she said, no, right? There's absolutely no one that does because there's too many cogs in the machine. But like, just go read price, right? If you want to make decisions, right? And be profitable. And that's when it hit me like, oh, so at the institutional side, there's so many cogs in the machine that there's no way that what I did at um, the the different levels of broking. You got executing broker, clearing broker, prime broker, and collateral and margin. None of them were correlated with price, and I kind of saw that firsthand, right? And coming back to this, right? So they laid me off in this last year. Me and 5,000 other people got laid off. Like that's what happens in the finance. And I spent the whole year and a half and continue boosting my knowledge and boosting my confidence and all that good stuff with your material, just to say like I'm finally at the edge where like over the last year, I'm not going to say the dollar amount, but let's just say I'm not going back to work.
Very good.
My family's not going back to work, and it was all thanks to like just a traumatic brain injury vet trading the non-dollar assets for the OTE at 1930 in Asia, and now it's 2026. And I know a lot of the community members in this room, and like I know you hate it, and I told Kid I want to say it, but like thanks for responding to me on Telegram back in 2017, and thank you for what you do, and for all the people out there, listen, like something he said, like nothing works statistically unless you can line it up with live price. Like this morning, there was a 83% chance New York won, meaning 9:30 to 11:30 would go up to come down. There's a 16% chance that it would continue going up. Now that 16% gets a weight, and if you don't understand whatever you use, the live price element, if you can't line up live price and that live price read, and sync it with whatever you use. Like I use probabilities of midnight, of settlement, of all that stuff, right? If you can't do that, if you can't find a way to line up that live price in the action, because I think of it like this: there's three levels to this game, right? The first level is the wiggles in the market, right? There's an endless possibility of them. The second level is the money management piece, and then for you guys who trade prop, the third level that you have to defeat is their rules that are completely skewed against you as a trader. So with that being said, like love your material. I'm done studying. I literally know everything I need to know about the daily profile, and I just wanted to say, salute to you, and I just wanted to update you because the last time we talked, you said keep me updated, and now we're 6 years later, and this is my update and my sit rep.
Thank you, brother. That was awesome.
Heck yeah. Bye.
That's my boy Michael. Matt, Mickey, and I have spent many a 4:30 a.m. Kind of pre-market game planning with our own trades and our own studies over the last 6 years. So it's nice having him come up, and he's changed his profile a little bit, but still good old Captain Matt Mickey. So thanks for coming up, buddy. Thanks for sharing your story, and I'm gonna transition to the next person. Reza is back. Reza, do you mind jumping in,
Hi,
buddy?
sir. Do you have my
Yes,
voice?
sir. I have your voice. Go ahead, jump in. You have a question for
Uh,
Michael. Thank you.
Hi, CD. Hi, sir. I'm really happy to be able to talk to you. I have been studying your concepts for 4 years. I'm Reza. I'm from Iran, and me and my team we are all ICD traders here. But before I just start talking, uh, feel free to interrupt me because I'm still not good at
Well,
English so much. I'm
how
still
old are you,
practicing.
Reza?
I'm 23 years
Okay, you're
old.
24 years old and
23.
23, and you've
Yes.
studied computer science, correct?
Yes, exactly. I'm just now working on making AI models. I mean, but I'm also an IC trader too. But recently, this last year, I just transitioned into algo trading. I mean, what I have done was I'm just working on algos, and also I see the concepts and I'm just turning it into algorithms because I know how to code.
Yes.
That's what I'm doing. Yes, I'm really happy to be able to talk to you after 4 years. Just before talking, feel free to interrupt me because I may make some grammatical or vocabulary mistakes in terms of English. So please feel free to do it. Uh, ICT, my question from you was, you know, um, me nowadays, the way that I trade is because I don't know whether you know what's going on in Iran, whether or not in Iran, if you just pay attention to most of the trusted platforms such as Apex or the most trusted ones, they just don't give access to Iranians, and we're not able to trade them. And there are so many, there are so many successful IC traders here, which just nobody knows them. And unfortunately, the way we trade is we don't have access to many trusted prop firms, and we usually trade with live brokers. And the way that I usually trade is I know some guys in here which have jewelry, and the way that I work is I just give them some specific levels on gold based on your concepts, and they just pay me. That's how I work with them because, as I told you, we can't have access to any trusted prop firms. My question from you was, uh, the way that I trade is I'm a market maker, modest trader that I just usually focus on 1 minute and sub 1 minute time frame. But still, sometimes I struggle really with finding the bias and order flow on 5 minute and 15 minute time frame specifically. Can you just guide me through this, sir, to be able to be much more good at it than I am right now? That was my question, sir.
That I like the question. That was very, very long. Hopefully, Michael, did you get that?
You're asking for pointers and hints and tips on how to get a bias or a better read on your bias on the 5 and 15-minute time frame.
Exactly, sir. I mean, reading the order flow and bias on what 5 and 15 minutes time frame I want to do because, usually I trade 1 minute time frame as I told you, but sometimes I just get the bias on those two time frames wrong, and I just want to be much more good at it. That's the reason why I seek your advice on this, sir.
So you're asking for basically session, intra-session bias. So let's just take it out a little bit. Let's go up
Exactly,
one.
sir.
Let's go up a little bit and say, okay, what time of day are you trying to trade? What session? Are you trading in London? Are you trading in New York? PM session?
Um,
Asia?
in Iran, we usually trade AM or PM session because London, most of the times people are sleeping at the time in Iran, but we usually trade AM or PM session. Sometimes London session do, but not too much. Specifically AM or PM session, I mean.
Okay. Could you say that 7 a.m. to 10 o'clock in the morning, those 3 hours, are they good operating hours for you Eastern time in the US? In other
Exactly,
words,
sir.
okay, so 7 a.m. to 10 a.m. New York local time. So if we're working with that, obviously the easiest thing you can do is start with where is the weekly chart drawing to, where is the daily chart going to, and we just basically did a clinic this month with a commentary I shared on the 7th of June. Just about every target except for the dollar index didn't go where I said it was going to go yet, but that's okay. I call it, and that's enough of a move. It's fine. But by using these higher time frame charts, you have to warm up to these and say, okay, where's the daily chart trying to go? And then once you subscribe to that view, you transpose that either bullish or bearish view into your sessions. Now, if you're going to be trading in 7 o'clock in the morning to 10 o'clock in the morning, that 3 hour window, you got to look at what it did overnight. So whether you're trading London or not, the details that are left in the wake of what it did overnight in London time frame, that's going to be the basis of what you're going to be utilizing for pre-session hours, 7 o'clock, 8 o'clock, 9 o'clock. And then you have 9:30 to 10 o'clock, which is opening range. And you can close up shop and be done by 10 o'clock. Or if you're not going to trade the pre-session hours like 7 o'clock, 8 o'clock, and 9 o'clock, and you're going to wait for just the opening range and trade 9:30 to 10:30, that's fine too. You only have a 1 hour work day, but you're going to miss a lot of opportunities that are going to escape you, and that's not a bad thing. But just be mindful that pre-session, 7 o'clock to 9 in the morning Eastern time, local time, New York, there's going to be lots of little setups in there that are just really dandy. They're just wonderful little setups. They're just easy. They're like you just walk right up to them and pluck them off the vine. It's just easy to see them. And that's relative equal highs and relative equal lows. So if you're going to be trading in that morning session in the New York time, referring to what London did, look for relative equal highs or a single high, or relative equal lows or a single low that formed between 3 o'clock and 5 o'clock in the morning. Real easy. It's real easy to zero in on that. It can't hide from you. And you find it on a 1 minute chart or a 5 minute chart time frame. And then you'll target that in that morning session. That's all you're going to be trying to do. So what you're doing is you're taking the bait that's been left for retail traders that traded overnight in Globex time, London, and they will build these relative equal highs or relative equal lows and make traders that are intraday trading in the Globex trust these levels as support or resistance. And then what you're going to do is you're going to cannibalize that. You're going to actually go after it. You're going to target those very individuals that have their orders resting there. So if you're looking at a daily chart and you think it's going to go lower, A perfect example of this would be in London, it created a relative equal high between 3 o'clock in the morning and 5 o'clock in the morning Eastern time or New York local time. And then what you'll see is the market will go up there many times in pre session and it'll bust right through those relative equal highs. Now, the people that just wake up and only look at what's going on in the morning session before the New York 9:30 opening, they're not many times even concerning themselves with London because they think that's already happened. What's going to happen right now? And they get caught up in chasing what's being shown in price action at the very moment, and they see that as a breakout. You see all these people out there talking about opening range gap. I'm sorry, opening range breakouts, orbs. Okay, to me, okay, you're chasing price, and there's sometimes where that works. But if you don't have a bias that's rooted in something that's on a higher time frame, you aren't doing it correctly. So this way, what you're doing is we're assuming the market's bearish because the daily chart has something it's drawing down into, some kind of a fair value gap, or it's reaching to an old low. Just look at what I did on June 7th video in analysis. Everything that I outlined there, that's what you're going to be doing on a day-by-day basis. Constantly giving yourself feedback of what do you expect it to do on a daily chart. Because if the daily chart's going to go higher or lower, the 1 minute chart, the 5 minute chart, the 15-minute chart, the 4 hour chart, everything that's less than a daily is going to be subordinate to that. It's going to do what that daily chart's doing. It's going to drop if it's bearish. So what we do is we want to see it attack relative equal highs. Now you can do two things. You can be universal, and if you can capture a long that goes up into a relative equal high that formed between 3 o'clock in the morning and 5 o'clock in the morning Eastern time, which is New York local time, that's the London session. You can target that as a raid and be bullish just for intraday, capture that, then use that as a buffer to then look for a short. So if it starts to break down, look for an bearish inversion fair value gap that you can go short and then run out the lows that just formed in pre-session 7 o'clock in the morning to 9 o'clock in the morning. And that's your whole day right there. And you don't even have to be there for the 9:30 opening bell. So what you're doing is you're simply looking at a bias that's determined by the daily chart. Then you're submitting yourself to only looking for something that fits that criteria. That means if you're going to go long, it needs to be very small, short term, and it has to be attacking the foundation of what you would use for a short, running out buy side, okay, while it's bearish. So what it's doing is it's knocking out people that would see that overnight as a means of resistance. So they could be short with their stop losses above that. So you're going to wait for that to happen and then wait for it to break down and then utilize some kind of an inversion fair value gap or model 2022. There's all kinds of ways you can do it. But then be short just looking for the low that formed in the pre-market session, 7 o'clock in the morning lows. Whatever low formed after it ran out those relative equal highs, that's all you're targeting. And be content with that. And that's session bias. I mean, that's literally like I sit with Caleb and Caden just about almost on a daily basis. And we do that just about 4 times, if not every day, every day a week. But generally, it's 4 times a week I'm doing that. And it may went over your head. It may some of you be like, oh, well, that doesn't interest me. But that's an everyday trading. That's an everyday trading model. And it's there all the time. But you have to have a read on price action relative to that daily chart. You can't just simply say, give me a time or criteria to use a 5-minute or a 15-minute time frame to take trades with a bias. You're going to have to go into overnight Globex trading, and you're going to have to refer to what the daily chart's doing. If you don't do those two things, you're not going to have a real read on the bias intraday or intrasession.
Thank you, sir. Thank you so much. Instead of the questions that I had, you just answered some other questions, which I just wanted to ask. Thank you so much for everything. And before closing my microphone, I just wanted to thank you for everything. Like me and my friends here, we're so happy to God guided us through you. My friends in here in Sanandaj, I mean, it's in city in Kurdistan province in Iran. Like whenever they just make a payout or just withdraw their profit, they just help poor people with it, and they're all thankful to you. And I'll just tell them that I just talked with you, and that's it, sir. Thank you for everything that you have did. You just changed my life, and the moment that I found you about 4 years ago, I think it was, yes, it was in the 2022 mentorship. Like, I know this is something that's gonna change me. I mean, I just had a gut feeling about it. And just thank you for everything that you had done for us. I will be forever
High five, Reza.
grateful to you.
High five. I don't mean to interrupt, but it's going to get emotional if you keep going. So let's try and keep
No,
it
no, no,
from.
no.
We're
Yes,
just
sir.
trying
I
to.
just wanted to just thank
Yeah.
You're
ICT.
trying to. You're
Yes,
trying to keep the graybeards from crying here. Okay, so do me that favor. Okay, just
But nice,
calm down on the
nice,
fanboy stuff.
yes.
Okay, pretty please.
nice that they're
Yeah.
helping
Just sorry for
people.
this. I just wanted
No,
to
it's
thank
okay,
ICT.
buddy. It's
Thank you so
okay. I'm
much.
just
So,
saying it's you're
thank you
we're
so much.
trying we're not trying to get tore up here, okay? We appreciate you. Thank you. All right?
Thank you, Mr. Kid. I appreciate
All
it.
right.
Thank you so much for giving me the opportunity to
Yeah,
speak.
no
Thank you
problem,
so
buddy.
much.
I mean, again, it's
You're,
we appreciate you. We do. We really do.
Thank you.
I appreciate your
Goodbye.
energy. I appreciate your sentiment, and be safe over there, and give your buddies my kind regards as well.
Yeah.
Thank you so much, ICT. Goodbye.
High five, Reza. Nice having you on, buddy. Got this gray beard
Thank you, sir.
tearing. You got this gray beard tearing up anyway. I'm like, "Dude, stop it, dude. We fucking love him, man. We know.
Yeah, I get I get real
I
uncomfortable with
know.
things like that because like I'm an introvert. I don't seem like I'm an introvert when I put on the ICT mask to perform and whatnot. But I understand the fact that you're here or you watch
Yeah.
my content.
It's
That means that you appreciate me.
it
It's
is
cool.
nice. I mean, I'm trying to protect that, Michael, and still let that there, right? Because it is a really nice
Yeah.
balance. It really, really is nice. And it is difficult, very delicate in respecting your feelings and the difficulties that you have with the appreciation and admiration that they have through their own difficulties, right? So it's like it's kind of beautiful. Again, I don't mean to I'm getting tore up here. Ah!
Mhm. No, but Michael has explained recently why it is,
Yeah.
because it's like it moves him, and then he gets out of focus and he just want to stay sharp
Right.
to answer the
Right.
questions. So yeah.
So it's understanding. It is. It's some. It's cool. It's a neat experience. Okay, I can just say it's neat for me. I got goosebumps. That's all I'm saying. I got goosebumps, guys. So
Just be mindful, though.
yes,
I'm a man. I'm not God. I'm not godly. I'm not a deity. I put my pants on just like the
yeah.
rest of you all.
And
Okay.
but you help
So
some folks out, buddy. You help some folks out,
yeah, but
and that's cool.
just
That's cool. And we'll just leave it there.
yeah.
No, it's all good. Thanks, Reza. Nice vibes. It was good vibes. Heaven, you're up next, my friend.
Hello, can you hear me?
Yes, sir. We can hear you.
Yes.
Hello, Michael. I just have a question for you. I pondered about this for 3 months, so I think it's a decent question to ask. How long did it take for you? So I'm at the moment. I'm just using one model, one process. How long did you spend on each individual model and process before you moved on to another model?
Some of them actually took a little bit longer because I was tinkering them much more than I should, and others were real fast because of the understanding I gained from the foundation that I picked up from just simply saying, okay, I'm going to get away from indicators. I'm going to start paying attention to time and what market moves are generally occurring around specific times. There was a large rush of like PD arrays that came out because of me focusing on very specifics. And when I was starting to see these characteristics materialize and being led to say, hey, look here, all those types of things started to like speed up. I would have periods where the old stuff that I discovered, I'd work with them and I'd try to make them better or try to improve them or try to add things to them and then just go back to saying, okay, this is all I could do with it consistently. So let's leave it to that. This is all it does. It doesn't do, it's not, you don't use a wrench as a hammer. And I was spending too much time trying to demand specific models or certain criteria beyond the scope of what would be used today in its final form with my material. And then I'd have a rush of all these things that would come at me at one time, and it was like it wasn't real continuous. Like every other month there was something new, and a new model would come real fast, or it'd be long periods where I wouldn't get anything at all. It's a varying type of thing, but the PD arrays really started to come in once I got about the basis of what I showed in my month 4 content. Once I had that framework, it was like I could see it in a way where I could communicate it and create a language around it. But before I had those very basic PD arrays that's in month 4 on paid mentorship stuff on my YouTube channel, before that, I was spending too much time chasing things that were not really beneficial to me. And I wasted a lot of time doing that. So that's why it took me 6 years to kind of like iron out all the stuff and say, okay, this is all it's going to do. This is all I'm going to demand of that. And I guess, I don't know if that answers your question, but it was not really I've never really recorded how much time I spent, or I guess I can go through all my journals, but good grief, that's a lot. That's a lot of research. I don't have the
Wow.
I don't have the energy.
Just to think of that, Michael, for people to think of grasping what you're explaining right now, it's like I think instantly I think of the schematic of a breaker block, of a mitigation block, and just an order block, and how it can be reclaimed. And I think of all of these things that you have taught, and being the author, you've had to have some form of schematic, and you do with the language, and you're explaining it right now very vividly. And these are the images I'm getting. Like, how long did he take to determine what a breaker block is? This is very specific criterion around each and every one of your PD arrays. There's no ifs, ands, or buts. They're very, very specific if then occurrences throughout the market.
Mm.
I mean, I don't have anything to add on that. I'm just like really almost flabbergasted at almost like actually thinking about how you put that together, because I have no clue, but it's
It was crazy. It was a lot of stuff to keep organized. A lot of journaling and note taking and research, and then taking time. And again, a lot of this stuff was being done before electronic trading. Like, it was being done in a means of me simply saying, okay, I'm going to watch this through a chart that I have to draw this chart out by hand. Like, I have to get the open, high, low, and close and draw that out. And then I got to wait for data. When we started to have a little bit more resources, and I used a tool called Metastock, and I was able to download end of day data. And then by having that, I could look at what the intraday chart was doing, and then look for types of patterns, and really focus in on time. And all these things started communicating in a way where it would give me, I use the term all the time, it's like a tapestry, like everything, like a quilt, like a well-made quilt. Every piece has its place, every piece has its purpose. And when you take a step back and you look at it, it's like, oh wow, like I didn't see that design there. But that's what it's like. That's what these markets are. They're obviously, we say it all the time. It's fractal. Okay, and what does that mean? Every component, every little thing that we see in price action is part of a larger whole. And when you can appreciate that, in the beginning, we really don't know what that means, and we can pretend that we do, because when we want to seem like we're outside the clique, we're outside the community. But it took a long time for me to determine what that was really entailing. What does it really mean when I could see something that was conceptually a small little piece of something? It's a one little cog inside of the greater machine. And when I was spending so much time worrying about that one individual little cog, I was oblivious to how it was part of something larger that made everything else click. It was like, oh, I know where this cog belongs in that time of the day, that time of the week, that week of the month, and that month of the year. And all these things started coming together. And then the epiphany is I'm looking at how all the puzzle pieces are there. And as long as I'm working around the border first, just like that's the best way you do a jigsaw puzzle, find all the smooth edges. Isn't that interesting? All the pieces that have a smooth edge. What do I teach you first? Look for the smooth edges. And that's how it came to me. That, just like that. And then all the other pieces in the middle, that's like intraday price action. But when you start seeing things that you are familiar with, what is that? What's the cover of the box? That's the picture of all the jigsaw puzzle pieces together. And say, okay, well, up here, I have an upper corner All the upper corner smooth edges are there. So the border of that jigsaw puzzle is already in place. So look at the picture. That's your frame of reference. What pieces and colors are in that little corner? Find all the pieces that have that color in it. Segregate it. What are you doing? You're trading in a specific session. And then you're looking for cogs, little fractal pieces, little things that run for smaller bits of data inside the borders of that jigsaw. And I was treating it the same way every single day, just building on this, building on this. And there were some times where I thought I had a whole lot more data and information before I really did. And I had false starts in terms of eureka moments. Like I got it figured out. And I really didn't have it yet. But I was working towards it. And I had days where I was, demanding something out of certain things I was working with, and they didn't deliver what I thought I was going to get from them. And I would cry literally in tears, and I'd be upset about it because I'm like, man, I thought it was going to be able to give me this, and it didn't. It fell short. And that's why I tell you all, don't demand so much when you're beginning because you don't know where this is going to take you. You don't know the superpower that you're gaining. You don't know. You don't know how to use these superpowers. Okay, you're all mutants right now without any understanding of what you can do yet. But given enough time and relaxing, you'll be able to do all kinds of amazing things.
A puzzle. That inspirational. Wangaro, Wangaro,
Mm, Yeah, yeah, I'm here.
you have a technical question?
Yeah, I want to post it.
We're here for your technical question, my friend. You can post it. You're going to post it in the chat, yes, sir?
Yeah,
Okay. Wow.
but before I post it, I
Did you
want to ask
can did
Michael.
you did you just hear what Michael just said? Like I can't.
Yeah,
I don't want to glaze over that. He's really talking about the tapestry of order block theory and like the real fundamental elements of not just the language or the theory, but where and how it interweaves together really does create that philosophy, that deeper meaning that you can utilize then within the market. And when you think of it's not unlocking, but it's a puzzle. And the order block theory, the order blocks are your puzzle pieces. And you're putting together a puzzle every day. And these are parts and pieces that you can utilize within the session. Anyway, I didn't want to glance over that because it was what Michael said is extremely profound. And he's the author. And I know, as well as most every other listener, you've spent quite a lot of time trying to understand this stuff. So it's really nice to have added depth in what we're dealing with, the PD array matrix, order block theory, open, high, low, close. I mean, his compendium.
When you strip it down,
That's
you break it down into that logic of you find the borders. Okay, the borders are what's the daily range? The daily range is all the smooth edges that border out that jigsaw puzzle. And then you're going to work with some location in there. Okay. I always like to go to the upper right hand corner. I got lots of jigsaw puzzles and I get them for gifts. I get them as gifts, rather. My daughter always gives me one Christmas time and birthday. And I always start in the upper right hand corner. Once I do all the border pieces, then I do the upper right hand corner. But I'm looking at the picture that is, if the picture or the jigsaw puzzle was completely done in the upper right hand corner, what colors, what shapes are in the picture, and I gather up all those pieces. So what am I doing? I'm filtering out all the stuff. I'm getting rid of all the noise. I'm getting rid of all the chaff. I'm not worrying about the shape of the pieces. That's just like you're going to be doing when you're watching live price action. When you're brand new, you don't know how the daily chart's going to form. You don't know that. And over time, what you'll see is there are very specific things that a bearish move is only limited to do certain things. It can go up to go down. It could just fall right out of bed. It can consolidate and cross over into a new session intraday, like PM or lunch, and then it has the run and drops lower if it's bearish. There isn't a whole lot of things that it's going to do. It isn't, or seek and destroy, but that's always a curveball. That's the jigsaw puzzle piece that you always are frustrated with. I don't know where this thing goes. I don't know where this thing goes. But by filtering out what you can see, which is time, that's not going to evade any of you. You know what time is. Simply look at the clock. You know where it's likely to go based on your higher time frame perspective. It's going to go higher or it's going to go lower. And you're submitting yourself to that. Well, I'm submitting myself to a session. I'm only looking in the upper right-hand corner of the jigsaw puzzle. And I'm looking for only the puzzle pieces that match the bias, which is the end result of that whole little upper right-hand corner of the puzzle being completed. I'm not interested in any pieces that have blue in it if that little area in the final piece of that puzzle doesn't have blue in it. So that means I'm not looking for bullish breakers when I'm bearish. I'm not looking for specific criteria that leads to higher prices. I'm not looking for that. So I'm activating my reticular activating system, and I'm only allowing information that's useful to my model, matching my bias for that time and session as part of the daily range. And if I know that overnight in the Globex that we have not really made any significant run, then the largest portion of the daily range is going to form in the morning session. So I have lots of expansion that could participate. But if there's a lot of movement that took place in London, then I'm not going to be so overzealous about demanding a lot of movement in New York, because New York can retrace back into what London did. And then PM session could return and resume going lower. And that's the same thing that we're doing in this analogy, is we're looking for puzzle pieces that match by color. Once you have all those pieces that match by color, then you can start looking at all the individual shapes. And that's the PD arrays, where they fall in all that little area and how do they connect. If you're bearish, you're looking for some kind of a Judas swing. Right off the bat, that's what I'm looking for. I want to see a relative equal high being taken from overnight in Globex. I want to see a single high taken. I want to see it reach up into a premium rate, not just take out a pool of liquidity, but I want to see it reach into something like a new day opening gap, a new week opening gap, the previous day's opening range gap, something to that effect. It's got to be something agreeing just simply. You can't just say, well, it's going into to liquidity. It's easy, as simple as that. No. It's got to go into that liquidity, yeah, at the right time, but it's also reaching into some kind of a premium array, something that is a justification why it went there, not simply because it went above an old high, because you can get hurt doing that. You have to have some kind of a context or framework to justify it went up to a premium array, some fair value gap, some new day opening gap, new week opening gap, or this past Friday's opening range gap, consequent encouragement. It trades up to that and takes out the buy side when I'm bearish. Okay, well, that's wonderful. But what if it doesn't have those things and it just starts to fall off right away? Okay, well, it has to fall from some short-term little high. So I'm going to look for the buy side and balance side efficiency right before that rollover. And then once it trades up into that as an inversion fair value gap, I'm in, I'm locked in. And I'm going to participate there. So what I'm doing is I'm looking at the puzzle pieces that the market's forcing in my hands. I can't control the cards that's being dealt to me, but when they're placed in my hands, I know how to play them. But you have to learn to be patient enough to know when the cards are dealt to you, you have your hand, then play them. Many of us look at the first two cards and we have three cards still coming, and we want to bet everything we have because we think it's going to be a winning day. We got two aces. That doesn't mean anything. The other traders that are bullish and you're trying to be bearish, they can come out with a full house. And you have no idea that it's coming like that. And you get smoked. And you're betting heavy early, anticipating the trade setup before it's actually there. So all these things we wrestle with. So you'll learn over time, there isn't a lot of things that's going to happen. And that's why it'll be easier for you to submit to a model. You'll be able to submit to the idea that when you do it wrong, it's okay. It's okay. That's just one transaction. The model's not broken. You're not a poor trader. Every trader is a losing trader. And I'll say it again. Every trader is a losing trader. You open up a trade, you're in a loss. You're underneath a commission. You're underneath a spread. If it's if you're trading forex, you got to come out of that, and you have to manage yourself and your expectation and stay focused. There isn't a. I know in most of your eyes and minds, when you look at price action, you're thinking, how is he picking? And how is these other students that are doing well? How are they picking that? Out of all the things he teaches, what made them gravitate to that? Like, why did they pick that? When I'm looking at this fair value gap here, or I'm looking at a breaker over here, or I'm looking at a reaper, or I'm looking at this and that and other thing, you're imposing your will. Where they have a little bit more experience, they have a little bit more underneath their belt in terms of knowledge. They have a little bit more understanding about PD arrays, whether they trade all of them or not, it doesn't make a difference, but you have to have some familiarity with them, which is the reason why I taught month 4 the way I did. Your catalyst to get into a trade may be order block, but if you don't understand fair value gaps, how could you reasonably expect to manage your stop loss without knowing where it's reasonable to trade up into an inefficiency like that? If you don't think in terms of fair value gaps and it starts to run up real quick, but you're not paying attention to the fact that it's only going up, the consequent encroachment of that imbalance that it just made 25 minutes ago. But you're thinking, it's reversing on me. What do? I'm going to get out. I can't hold it anymore. Then you get out, then it rolls over and it continues and it has the bigger run. But you didn't have the wherewithal to get back into it because you're now shell shocked. So the way I teach and the way I taught in that mentorship is I'm giving you puzzle pieces. I'm giving you things that you can use to go into the chart every day, and you should break down every single day. Every single day when you journal, draw out with a line chart. Don't do it with the chart turning to a line. You need to draw it out with your hand. It doesn't take much to do this. Where the open was, how much it went up, and now how it behaved and made the low, and then where it settles. By doing that and you drawing that, what you're doing is you're allowing your subconscious to retain that. If you just let the chart turn from a candlestick to a line chart, that's not the same. You're all looking for too many shortcuts. That's not going to be retained subconsciously. But by you drawing it out, that's why I'm a very strong proponent of high touch over high tech journaling. You're gonna write down things that mean something to you when the pen is in your hand. And when you have that and you draw these little diagrams out of every individual day, and then next to that, draw out what the London session did on a line chart basis. You're handwriting this. You're drawing it out. You don't have to be an artist, okay? It's just a rough depiction. And then when you wait for the New York session, and when we get into 11:30 and the lunch macro begins, how did that morning session trade? What would it look like? If all you looked at was from 7 o'clock in the morning to 11:30, what would that look like if that was the entire daily range through the lens of an intraday chart? What was its movement, higher or lower? How did it form? Its highest high and its lowest low. Where did it open? Where did it close at 11:30? And do the same thing for the lunch macro between 11:30 and 1:30. You're building puzzle pieces. Can you see that? And then when you do the PM session the same way, and then the last hour of trading, you have an infinite realm of study that you never will exhaust. But when you break the market down like this, you're going to see there isn't a whole lot of things that it does. It's only a handful of things that it does to make these sessions and these intraday fluctuations or the daily range. It's not morphing into some kind of a like it's unrecognizable. They all are similar, but it's only part of a handful of profiles that you got to get warmed up to. And those profiles, those little intraday profiles, can be taken down to the session level too. And once you understand that, it's like a little template, a little cookie cutter. And you're not going to be surprised. You're like, oh, this is probably going to create that run higher, then drop, or it's consolidating right now. Okay, it's waiting for some kind of a news event. Then it's going to run up here and get the liquidity and then sell off. So it gives you a whole different appreciation for being patient because you know what you're waiting for. It's not a You're not standing in front of a major league pitcher and they're throwing a 120-mile-an-hour fastball at you, okay, and you don't know what to do. You've been here before. You're up the bat. You know the pitcher. You got a high batting average, and you're the major league player. You're MVP. You get the highest batting average for this season. You're a veteran now because you look at price in a way that's scientific, not reactionary. You're not reacting to price. You're looking at price, you're studying it like a detective and looking for clues. This thing's going to repeat something that I'm familiar with. And unless I can recognize it, guess what I'm not doing? I'm not taking a trade.
Bang. Showstopper. Good day at Trader Roundup. Michael, we've been here about an hour and a half. What? How are we looking as far as time? Just curious.
I'll take one more. I know we had a gentleman who was going to ask something. Let him finish
Yes,
and
we
see
got
where we're
one
at.
Garu here. We got one Garu here.